Hello, I'm Curt Long, Vice President of Data and Research and Chief Economist for America's Credit Unions. Affordability has been a salient issue. It's been a focus for the last two elections, and it may stay that way for a third. For credit unions, lower affordability drives down loan demand and drives up credit risk. We know that credit unions are the most affordable lenders on the market, but how are credit union members doing? And is this an affordability crisis? Let's take a look. This is overall consumer sentiment, and it's not a pretty picture. In fact, it currently sits just above the all-time low. I don't think too many people would say that the U.S. economy is firing on all cylinders, but it's puzzling to see such a dramatic display of consumer pessimism when GDP growth is strong and the unemployment rate is relatively low. One hypothesis is that even though the economy may be performing well in the aggregate, it's mostly well-off households that are benefiting. Meanwhile, lower-income households might be seeing their financial conditions deteriorate. This would be less likely to show up in the so-called hard data, things like GDP and consumer spending, since lower-income households don't have the same economic footprint. It's true that our hard data has lots of holes, but it does suggest that lower-income households are seeing their financial situations improve. The Federal Reserve Bank of Atlanta estimates that wage growth for low-income workers is 3.5%. That exceeds inflation and is well above where it was in the early 2010s. This chart shows balance sheet components for the bottom half of U.S. households by net worth adjusted for inflation. And real net worth for these households is on the rise. Also, their ratio of financial assets to consumer debt is at its strongest level since the 1990s. This is not to say that the bottom half of households are doing as well as they should be, nor to ignore the real financial struggles of countless households across the country. Far more people live on the margins than they should, which makes credit unions' mission of serving their 145 million members all the more important. But we are left with the question of why people are so unhappy with this economy when it's similar to past ones they were quite happy with. Another potential answer is that even though inflation has subsided from its peak in 2022, people are still upset about it. They don't just want price growth to slow down, they want prices to return to where they were prior to the surge. This chart shows the inflation trend in white alongside the share of consumers who say their financial condition is worse than it was a year ago due to inflation. The two track closely through the inflation peak, but as inflation has moderated, consumers have not seemed to notice. If anything, they are more likely to report that prices are harming their financial situation. This suggests that it may just take time for consumers to reset their expectations and to come to terms with current price levels. If that's the case, then there should be good news in store. Most forecasters, including America's credit unions, expect inflation to gradually slow over the next 2 years, meeting the Federal Reserve's 2% inflation target by 2027. But there is another channel for consumer unrest, and that's homeownership. When we look at the consumer survey, the influence of homeownership plays an interesting role. Homeowners tend to report higher consumer sentiment than renters, but during the inflation surge in 2022 and 23, that pattern weakened. This is not too surprising since home values took a small hit during this time. However, since early 2023, the gap between homeowners and renters has been much wider than the historical average. One benefit of homeownership, especially with a fixed-rate mortgage, is to lock in a large percentage of your budget. When you go through a period of high inflation, it drives home the fact that if you do not own a home, your financial situation is exposed to economic conditions in a way that homeowners are not. Add to that fact that housing affordability is far worse than it's been in recent history, and it's no surprise that renters would be especially unhappy about the economy. By virtue of providing better interest rates than the competition, credit unions are part of the solution. Using our access to credit bureau data from Equifax, we find that a typical credit union borrower will save $2,200 over the typical financing from a mortgage company over the life of the loan and $22,000 over the typical bank financing. So, is this a broad, sweeping affordability crisis? The hard data tells us not really, but that doesn't change some of the factors that credit union members are worried about. Yes, the situation with rising prices is leveling out, and home prices have flattened. But today's borrowing costs keep the barrier of entry high. Beyond offering better rates, there is not a lot credit unions can do to improve overall housing affordability conditions. However, it's important for credit unions to be mindful of this dynamic. Today's renters are eager to own their first home, and to the extent credit unions can provide avenues for homeownership, they'll be addressing a key source of economic anxiety for their members. But maybe the most important thing credit unions can do is the same thing they've been doing, offering the most affordable financial products on the market. That does it for this month's Economic Update video. We'll see you next time.